This is not just a price move, it's a message, a signal hidden in plain sight. When silver moves this fast, when it breaks levels this quietly, history shows it's rarely about silver alone. Behind this jump lies pressure building across currencies, industry, and policy decisions few are openly discussing. Smart money notices first, late money celebrates last. The question is not why silver moved today, the question is what usually follows next, and who is unprepared when it does. Welcome to Boring Currency Index. If you've spent decades watching markets rise, fall, and repeat their mistakes, this channel is built for your experience. Consider subscribing, not for excitement, but for clarity and long-term perspective. And before we continue, tell us in the comments, from which country are you watching today? Silver surged higher, reaching $94.14 per troy ounce after a strong 1.6% jump. On the surface, it looked like another market headline. A price move, a number, something traders might notice and then forget. But to experienced observers, this was not noise. It was a signal. They understand that silver does not move quickly without reason. Unlike many assets, silver sits at a rare crossroads. It is both a financial metal and an industrial input. When it rises sharply, it often reflects stress building somewhere else in the system. The price move itself matters less than why it happened and when it happened. This rise came after months of steady gains. Since the start of the year, silver was already up more than 30%. That kind of momentum does not appear by accident. It usually forms when multiple forces begin to align at the same time. Currency policy, industrial demand, and investor positioning start to push in the same direction. When that happens, prices move faster than expected. They also note the timing. The jump did not come during a crisis headline or a major geopolitical shock. It happened quietly during normal trading conditions. Historically, this is when markets reveal the most information. Sudden moves during calm periods often point to structural changes rather than emotional reactions. Silver's role as a monetary indicator is often underestimated. When confidence in paper currencies weakens, capital tends to flow first into assets that are still considered real and limited. Gold usually leads, silver follows, but when silver accelerates faster, it suggests rising urgency. It shows that participants with smaller capital bases are also moving to protect value. At the same time, silver's industrial importance cannot be ignored. Modern economies depend on it. Electronics, solar panels, and energy systems all require silver. When prices rise despite higher costs for manufacturers, it signals that demand is strong enough to absorb those costs. That alone tells a story about the direction of economic priorities. For business leaders and entrepreneurs, this moment deserves attention. Silver is not sending a message about speculation. It is reflecting pressure inside supply chains, currencies, and policy frameworks. Those who ignore early signals often react too late. The surge to 94.14 is not a conclusion. It is an opening chapter. And history suggests that when silver speaks this clearly, it is warning that larger shifts are already underway. As silver continued its climb, analysts focused less on the price itself and more on the forces pushing it upward. Markets rarely move without cause, and in silver's case, the drivers were both visible and structural. They were forming beneath the surface long before the price reached $94. One of the strongest forces came from industry. Silver is no longer just a store of value or a historical metal. It has become a critical material for modern technology. Solar energy systems rely heavily on silver for efficiency. Electric vehicles use it in power controls and battery systems. Electronics depend on it for connectivity and reliability. As these industries expanded, silver demand rose steadily, not suddenly, creating long-term pressure on supply. They observed that demand growth was not limited to one region. The United States increased investment in renewable energy infrastructure. China continued large-scale manufacturing in electronics and solar technology. India's jewelry and industrial consumption remained resilient, even at higher prices. When demand rises across multiple economies at the same time, price sensitivity declines. Buyers are willing to pay more to secure supply. On the supply side, silver production struggled to keep pace. Mining projects take years to develop. Costs rise quickly when energy, labor, and regulatory pressures increase. Unlike paper assets, silver cannot be created instantly. This imbalance between slow supply growth and fast demand growth created a tight market, even before speculative interest appeared. They also paid attention to the behavior of manufacturers. Instead of delaying purchases, many chose to lock in supply. This behavior signals expectation, not fear. It suggests that higher prices are being accepted as the new normal rather than a temporary spike. That acceptance often marks a transition phase in commodity cycles. Another factor was currency movement. A softer US dollar made silver more attractive to international buyers. As purchasing power shifted, global demand increased without a visible surge in trading volume. This quiet accumulation often precedes more public price action. For decision makers, the lesson is clear. Silver's rise was not driven by excitement. It was driven by necessity. Industrial growth, limited supply, and global demand alignment created a foundation that prices could not ignore. This makes the current move more durable, but also more dangerous. When fundamentals lead price, markets tend to overshoot before stabilizing. Those watching closely understand that silver is no longer reacting. It is responding to changes already in motion. As silver pushed higher, attention shifted to a quieter but more revealing measure, the gold to silver ratio. This ratio does not make headlines, yet professionals rely on it to understand relative value inside the metals market. When it moves sharply, it often changes the entire conversation. At the time, silver reached $94.14. The ratio had fallen close to 51. This meant it took only 51 ounces of silver to match the value of 1 ounce of gold. They remembered that just a few years earlier, the ratio regularly sat above 80. Such a dramatic shift does not happen without meaning. It signals that silver is outperforming gold at a rapid pace. They understood why this matters. Gold is usually the first metal investors turn to during uncertainty. Silver follows later, often when confidence continues to weaken or when industrial demand strengthens at the same time. A falling ratio suggests silver is no longer just catching up, it is leading. That leadership is important, but it also carries risk. Historically, when the ratio falls too fast, markets pause. Silver tends to move in powerful bursts, followed by periods of consolidation. This does not mean the trend is broken, it means the market needs time to adjust. Businesses exposed to silver prices often feel this adjustment before investors do, through cost changes and margin pressure. They also compared the current ratio to past cycles. During periods of aggressive monetary easing, silver often outperforms gold early, then slows as policy expectations shift. If central banks signal hesitation or restraint, silver usually reacts first. That sensitivity makes the ratio a warning tool, not a prediction. For entrepreneurs and business planners, this information is critical. A low ratio suggests silver may be stretched relative to gold in the short term. Ignoring that signal can lead to poor timing decisions, especially when volatility is rising. They did not interpret the ratio as a reason to exit completely. Instead, they saw it as a call for discipline. Strong trends attract confidence. Ratios reveal when confidence turns into risk. Silver's strength was undeniable, but the gold to silver ratio was quietly reminding observers of an old market rule. When one asset begins to run too far ahead, balance eventually demands a pause. And those who prepare early usually protect more than those who react late. As silver approached new highs, the conversation shifted from opportunity to risk. Strong trends attract attention, but they also increase volatility. Experienced observers knew that when prices rise quickly, the margin for error becomes smaller. Silver was no longer just moving higher, it was moving faster. They focused closely on the policy environment. Over the past year, central banks had moved toward lower interest rates. The shift reduced the appeal of cash and bonds, making non-yielding assets like silver more attractive. As money searched for protection, silver benefited. But policy support can change. Even a pause in rate cuts can alter market expectations. Silver is highly sensitive to these signals. Unlike gold, which often moves steadily, silver reacts sharply to changes in outlook. When confidence is strong, it rises fast. When confidence weakens, it corrects just as quickly. This behavior increases both opportunity and danger. Volatility in the silver market had already begun to rise. Options pricing reflected this uncertainty. Higher volatility means higher risk for unprotected positions. It also means that sudden pullbacks can occur without warning. Those who entered late, driven by price rather than analysis, were most exposed. They emphasized the importance of risk management. Businesses with silver exposure needed clear strategies. Locking in prices, using hedges, or setting strict limits became essential. Holding large, unprotected positions at elevated levels was no longer a strategic choice. It was a gamble. They also watched data closely. Industrial production figures, currency movements, and central bank statements now carried more weight than daily price changes. These indicators would determine whether silver could stabilize or whether a correction was likely. The rise to $94.14 marked strength, not certainty. Markets often test conviction after strong moves. Silver was entering that phase. The trend remained intact, but the pace demanded caution. For decision makers, the message was direct. This was not a moment for excitement. It was a moment for awareness. Silver had delivered its signal. What followed would depend on discipline, preparation, and the ability to act before conditions changed.